Hey guys, welcome back to another video. In today's video, we're going to talk about a very interesting option strategy called the butterfly spread. So basically, this strategy is great for when you expect the price of an underlying asset to remain relatively stable. Okay, so we're going to go ahead and see how it works right now. So basically, right here with the butterfly spread, basically that's an option strategy that combines elements of both debit spreads and credit spreads. Okay, so debt spreads. And credit spreads. So it involves buying and selling options with different strike prices, but the same expiration date. So as you can see here, we have 55, 45, 50, and I'm going to explain that in a second. Okay, so basically the goal here is to profit when the price of the underlying asset stays close to a specific strike price until expiration. So for example, if the price of a stock is at 50, by the expiration date, the price doesn't move too much. So the strategy is here is only profitable or good once you have a stable market. Okay, so if it's too volatile, then it's probably not going to work. Okay, and I'm going to explain the risks in just a little bit, in just a little while. So how can we set up a butterfly spread? So to set up a butterfly spread using call options, you're gonna have to follow these steps. Okay, so the first step will be you're gonna buy one call option with a lower strike price. So for example, if the price is at 50, you're gonna buy one at 45, for example. So you're gonna be buying a call option with a lower strike price, and you're gonna be selling two call options with a middle strike price. Okay, that's step number 2. In step number 3, you're going to buy another call option with a higher strike price. So for example, 55, right? So again, let's try one more time to make it easier. So let's imagine we're using options for a stock that's currently priced at $50. So this one right here. Okay, so here's what we're going to do it again. Step 1, you're going to buy one call with a strike price of 45. So this one, you're going to buy that at 45. Now, step number 2, you're going to sell two calls with a strike price of 50. So you're going to sell two calls with a strike price of 50, and you're going to receive money from it. Okay, with this, you're paying, so you're negative. Oh my God, that's really bad. So you're negative, and here you're positive because you're receiving, because you're selling. When you sell something in options, you receive a premium, okay? And then you have step number 3, which is buying a call with a strike price of 55. So again, you're negative again. Okay, so we're going to go through a practical example to illustrate. So again, suppose the stock is currently trading at $50. So you believe the price will stay around $50 until the options expire. So it could be for a week or a month or whatever the case may be. It's not volatile. You might be thinking that the stock's going to stay around here. So that's smart to do the strategy. So basically, for the butterfly spread, you're going to decide to buy one call at 45, which is going to cost you 6. Okay, so this one at 45 is going to cost you $6. Okay, so $6 here. You're going to sell two calls at 50, each one costing $3, but you're selling two calls, so you're going to receive $6 here. So you're positive $6, and here you're negative $6 because you're buying. Okay. And then number 3, again, 55. You're going to buy one call at 55, which costs $1. Again, so $1 here, you're minus negative. So that's pretty much it. Okay, so the total cost to set up the strategy will be buying one call at 45, which is going to cost you $6, selling two calls at 50, which you're going to receive $6 because it's $3 times 2, so it's $6, and then buying one call at 55, which is going to cost you an additional $1. So in total, you have 7 minus 6, so you have 1. Okay, so 7 because of the buying options minus 1 of the receiving. The two options that received. So 7 minus 6 is 1. Okay, so initial that 1. Basically, how does it work? How does it make money? So how can you make money with it? So the butterfly spread is a limited profit. So limited profit and limited risk strategy. The maximum you can gain is the difference between the middle strike price and the lower strike price minus the initial cost of the strategy. So around here. Okay, here would be the limit that you profit off of it. Anything above it, above 55 or below 45, you're gonna start losing money. It's limited, but you're gonna start losing it. Okay, and you can lose pretty much everything that you put as well, because it's not a like salary based an income strategy. It's more for speculation. Okay, but that doesn't necessarily mean it's a bad thing. You just need to know what you're doing, but it's kind of how it works. And yeah, so in this example here, as I showed, so if the stock price is exactly at $50 at expiration date, so the 2 calls you sold will expire worthless, but the call bought at 45 will be $5 in the money, and the call bought at 55 will expire worthless in this case. Okay, so the gross profit would be $5, so that is 50 minus 45. So this one, 50 minus 45. Okay, and this will be $5 in the money, and the call bought at 55 will expire worthless, because that's how it works in options. And so the gross profit again, $5, which is 50 minus 45 minus the initial cost of 1, is going to result you in a net profit of $4. So in this case right here, you actually you made 4 times as much your initial investment here, if you actually get the chart not to move higher than 55 or 45 or below 45. So in this case, you doubled, actually you tripled your investment here. Triple or quadruple. I don't know how to say that word in English, I'm sorry, but you got what I'm saying, right? So if the stock price is above 55 or below 45 at the expiration, all the options, they're going to expire worthless. Okay, or the spread between the options will be the same, so resulting in a maximum loss of $1, which is the initial cost of the strategy. So again, the risk here is you can lose potentially everything that you put. So if you put like a $200 in this strategy, and if the market doesn't stay in this range between 45 and 55 at expiration date, you're going to lose $200. But on the other hand, if you actually get the move right, and the market stays between this range, you can literally double, triple, and quadruple your investment. So it can go from $200 to $800, $700, $600 in this case. Okay, so that's kind of how it works here. Depending on, again, that depends on the strike price, of course. Okay, but it's kind of how it works. And again, when are you going to use the butterfly spread? So when does it make sense to use the butterfly spread? The strategy is ideal when you expect a low volatility, just like I said, in the stock price, and believe it will stay near a specific price until expiration. Okay, so it's a market neutral strategy, perfect for traders looking to capture option premiums with controlled risk. So that's the only reason to why you do the strategy in the first place. Okay, and like I said, you can use, the good thing about options is that you don't have to solely rely on one strategy. You can combine multiple strategies at the same time. Some people, they do iron condor with butterfly spread, with calendar spread, with this, with that, or whatever the case may be. Some people, they do like, for example, cash secured put, which you can earn an income, a premium, and then you can use some of this premium to try another strategy to try and leverage your money. So for example, let's say you earn $1,000 in covered call, and you want to use like 50% of it, $500 to try and use butterfly spread. You can use it, and if everything goes wrong, you're going to lose just the money off the market. And if everything goes right, you can quadruple or triple your money, and then you can turn like $1,000 into $2,000 to $2,500, and then you actually get a higher percentage without necessarily taking more risk than you should. So it is good. Like, these speculative strategies, they're good for you to combine with these other strategies that I said to you in the video, and that's kind of what it is. But ultimately, it's up to you and your risk. So you gotta know what you're doing. You gotta really know what you're doing with it, because you don't want to lose all your money doing this thing, because you could. Okay, so you gotta understand it, and once you understand the risk and reward ratio and that kind of stuff, then you're probably good to go. So it's like a weapon, you can use it for the good or for the bad. So make sure you use it for the good, and use it to enhance and increase your interests rate that you get monthly, rather than, I don't know, maybe just blowing up your account and losing money, because it could happen. And a lot of people, they're going to end up losing money here because they don't have control or knowledge or whatever the case may be. But I'm here to help you with that. Okay. I'm not saying I'm a master of anything, but at least with the little knowledge that I have, I'm going to try to do the best for you so you can learn some more of options trading. So that was the video. Thank you so much for it. I know it seemed a little complicated, but you're gonna get it eventually. All you have to do is just keep repeating, seeing more, study, repeat it a million times. It's gonna become second nature. Okay, so thank you so much. I'll see you in the next one. Subscribe for more, and that's it. Bye.